Okay, Tanya, we'll leave it at that. In fact, also would like to highlight some of the earnings as well. And remember, yesterday the big disappointment really came in from MCX's numbers. So within minutes from now, we're going to be chatting with the management of MCX, Mrugank, Paranjape, MD and CEO, and try and understand what really went wrong for them and why this kind of a hit that you saw in MCX's performance. Mr. Paranjape, hi, good morning. Your numbers have been extremely weak this quarter. What explains the dip in your top and bottom line, firstly?
If you go through our numbers in detail, what you would see is three things which stand out. On the operating revenues, the dip is very small. It is 9%, which is absolutely in line with the way the ADT has shaped over the last quarter. Now in the commodities business, in the commodity cycle, ADT in the third quarter of the year lower than the Q2 is absolutely a trend that has been there for the last so many years, and therefore it's not really out of line. The second aspect of our this quarter results is again the absolute tight control that we have kept on our cost base. So the non-variable cost base, which we had promised would remain flat to last year, in spite of all the incremental expenses we have done for member engagement, for launch of the options, for our manpower. In spite of all of that, the full year cost numbers will come in absolutely at the same levels for the non-variable costs. I think where you see the dip is something which something which you are going to see in probably every financial services organization which has a large exposure to mark-to-market on account of debt instruments. This has happened because there was a very steep rise in the bond yields, which basically resulted in a huge divergence between the mutual fund yields that people got for their portfolios versus how the bond yields looked at. So in our case as well, while we have consciously tried to move away from instruments which have large mark-to-market variance in our mutual fund portfolio, it is something which we are doing over time. We believe that over the next 6 to 9 months we will have moved away in a big way, but we will do that in a way that it doesn't also create too much tax liability for us. So that's the reason why you see a big variance, and all of it comes through our other income and on account of the bond yield changes.
On the average, daily trading volumes have declined by nearly 8% quarter on quarter. What is leading to such a big drop in your volumes, and what could be the impact of that on EBITDA margins?
So I think in our business, these three segments have almost been equal drivers. Though of late, bullion has been on the lower side and is closer to like a 20% rather than the earlier 30% plus, which it used to be in the last financial year. This quarter as well, the big dip has really been on account of the bullion volumes, which went down, and the bullion volumes were down approximately 30% as compared to the last quarter. But again, given the diversity of portfolio that we have, the metals volume have helped us. They are about up 20%, and that is really what has made up in terms of the differential. Crude and natural gas both behaving a little bit differently. Natural gas has picked up a lot over the winter as it has come in, whereas crude again has had a slight dip. So energy mainly remaining almost flat, but it is really the bullion and the metal segment which have given the variance in the volumes. Having said that, we are already seeing some recovery on the bullion segment as well, and overall in the market. The first 10 days of January, our ADT is up almost 10+% over the last quarter, and that's something which we feel very healthy and good in terms of the numbers that we see going forward.
Right. Mr. Paranjape, based on the traction across commodities and their respective price trend, what kind of growth do you see in the average daily turnover in Q4?
So I think it's always been very difficult to predict a near-term next quarter number in our business because it's a factor of many things. We still firmly believe that the sort of organic growth or secular trend that we see of a 8-ish% growth in this market is something that this market will always deliver in terms of the growth, and that's based on various initiatives of the exchange, expansion of new commodities, but this is in terms of the existing business. On top of that, you overlay the impact of institutions, the impact of index, the impact of options, and then you get a much different trend probably in a 3 to 4 year scenario.
Right. Mr. Paranjape, have to verify this because, you know, reports are indicating that Kotak Mahindra Bank is looking to divest its stake and trim the holding before BSE and NSE launch their suite of commodities. Do you think a domestic exchange like BSE or a global one would be would be preferred over institutional investor for that stake of 15%?
So I think any sort of questions around shareholding best asked to the investors. We really can't comment on investors and their decisions.
Yeah, but anything that you've heard from interested parties, any confirmation, anything that you're hearing from Kotak's end?
Nothing that we have heard from anyone.
Okay, Mr. Paranjape, we'll leave it at that. When we do get an official confirmation, we'll chat again. Quick break with news that the SGX Nifty is indicating a quiet start irrespective of commodities taking a knock globally, and that was pretty much the case across global markets as well. When we come back, fundamental chat.